My name is Sylvan J. Rahman. Welcome back to Intentional Wealth. Today I want to talk to you about one of my most favorite real estate strategies, and it's allowed me to see a 24% return on my investment. Now, this strategy, funny enough, has been used by my parents for the last 20 years, and I never knew about it until I talked to my dad recently. Now, it is a strategy that I've actually been able to use in real estate to see higher returns, and I've actually been able to use it to buy a coffee shop for $20,000 out of pocket. What is that strategy and how do you use it? Well, stay tuned to the rest of the video and we'll get right into it. Before we get into the video, I just want to let you know that I am not an attorney. I am not a CPA or a licensed real estate professional. And in fact, this is just my opinion on my experience in doing real estate and doing business for the last couple of years. Before we get too much more into the video, I want to let you know about some terms that we're going to use so that we're all on the same page. The first term is mortgage. What is a mortgage? A mortgage is basically a debt with real estate used as collateral against that debt. So we wouldn't say, I have a mortgage on a car. No, that's not real estate. So what you would say is, I have mortgage on this house or on this piece of property, whether it's commercial or residential. The next term is interest. What is interest? For me, I basically say that interest is the cost of borrowing money. It is the extra money that you're gonna pay to use someone else's money. Down payment. What is down payment? Down payment is the payment made to initially take out a loan or to use a line of credit. The next term is equity. What is equity? I basically like to think of equity as ownership in something. So let's say you have a $100,000 house, you put $20,000 down. Over the next year, you pay $5,000 off. And after a year, you sell the house for $100,000. Well, your portion of the equity is your down payment plus whatever you've paid off, which is $25,000. So when you sell that house for $100,000, the bank is going to get $75,000 and you're going to get $25,000. And that $25,000 is basically your ownership in that asset. One of the biggest terms used in real estate is amortization. Amortization is basically the amount of time that you're taking to spread out payments over a set period of time. Another term that is mostly used in the fix and flip community of real estate is ARV. ARV stands for after repaired value. That is basically the value of a property after it is fully repaired, nothing else needs to be done, it's totally move-in ready. The last term is balloon payment. What is balloon payment? Basically, it is the principal amount owed on a loan at the end of a loan period or amortization period. As an investor, keep in mind that the thing you want to do is you want to invest the least amount of cash possible into an investment to get the maximum returns on that investment. Now, that return can either be in a dollar amount every month or a percentage over a year, dependent on that initial cash investment. And that is why the strategy I like to use in real estate investing is something called owner financing. Owner financing is a broad term used for different strategies that are used within the owner financing umbrella. Now, those different strategies all depend on the debt or type of mortgage that is on the current property or investment that you're looking at. But to simplify today's video, I'm just going to tell you about an owner financing deal that I did recently this past December. So a deal came across my desk a couple months ago through one of my partners. It was an investment property that was being offered for sale at $275,000. Now, getting into some negotiating and looking at the deal a little more and doing some investigation, we realized that we weren't going to pay $275,000. And this is why. The $275,000 that this house was offered for was the after repair value. And if you remember, the after repair value is the value of the house after it's all repaired, ready to move in with a new owner or a new renter. And the thing was, this house needed $30,000 to $40,000 worth of work. After negotiating with the seller for a little bit, we agreed on new terms, and the new purchase price that we agreed to was $227,500. Now, the one thing I like about owner financing is everything is negotiable. If I had went the traditional mortgage route, I would have had to have paid about 20% down and at 5% interest and possibly a term of 30 years. That's none of those things I like doing. First of all, I don't like long terms. The interest wasn't right because you can actually get lower interest on owner financing, and in this case we did, and that 20% down actually equates to $45,500 out of my pocket. Now, what were we able to do with owner financing? We were able to get the house for 8.8% down, which is basically $20,000 for a $227,000 property, right? We were also able to amortize it over 30 years with a 3.5% interest rate, and we would have a balloon payment in 10 years, meaning we would pay a monthly payment as it was a 30-year loan, but whatever principal was left at 10 years, that would be our payment to get out of that house and own it free and clear. To give you an overview of why we chose to do the owner financing route and why we made the deal that we made, it's because what I said before, that as an investor, you want to get the maximum returns for the least amount of money invested. So with the traditional route, we would have had the same purchase price of $227,500. The mortgage terms would have been probably roughly around 30 years at 5% interest with a down payment of $20,000. That $20,000 equals about to $45,500. Now that comes out to a rough mortgage payment of $977, which comes out to a positive cash flow of roughly $622 per month. With owner financing, we were able to do a different deal that worked out much better for us. We were able to buy it for the same purchase price of $227,500. The terms were a 30-year amortization with a 10-year balloon payment. That means at the end of 10 years, whatever principal is left, we have to pay that whole thing off to get the house free and clear, or we have to refinance that 10-year principal amount. Now, we were able to get it at 3.5% interest, and that works out to a rough mortgage payment of about $1,113, with an approximate cash flow of $486. Now, you're probably wondering, Sylvan, why would you go for the owner financing route when you're getting roughly about $200 less positive cash flow than the traditional mortgage? Well, the reason is because with the traditional mortgage, I invested more money up front, giving me a percentage return of roughly 16% return on my money. With the owner financing route, I was able to get, yes, a higher mortgage payment, less cash flow up front, but I was able to get a return of roughly 24 to 25% return on my money every year. And if you can get that in the stock market, please call me because I want you to manage my money. Now, you're probably thinking, wouldn't it be better to get a traditional mortgage with a 20% down payment so that you have more equity in the house? That would be great if you're looking to occupy the home or you're buying this house for yourself, not as an investment. You need to remember that I'm a real estate and a business investor. So what I do is I try and do exactly what I said. Invest the least amount of money for the maximum amount of return. Now let's say I had $45,000 to use for property investments. Well, let's say a deal came across my desk where with traditional mortgages, I would have to use that full $40,000 for a down payment. That would equate to probably a house that's worth $200,000. Well, that's all great and everything, but I only own that one house for $40,000. But if I was able to find multiple owner financing deals for fractions of that $40,000, I could either own 4 houses at $10,000 each, or even 2 houses at $20,000 each, giving me a higher rate of return on the money I invested. And that is what all my partners want from me, and even more so, myself. This game is all about getting the maximum rate of return for the least amount of money invested. If you agree or disagree with anything that I've said, or you have questions regarding this topic because I wasn't clear on something, please comment below. I'm always open to discussion. If you did like what I said or you liked the video, please consider subscribing to the channel, liking and sharing the video, and follow me on Facebook, Instagram, and Twitter. And follow me next week when I share with you how I bought a coffee shop for the same price as this house. Get nervous and scared that I'm like ready on time. It's just like, yeah, yeah. And then I was like, oh my God, he's ready on time, right? And she's like drinking. She's